Question 5. The following trial balance was extracted from the book of Adama PLC as at June 30th, 2022. We have the trial balance, which consists of freehold land and building at valuation. Okay, okay, sir. We have additional information. Can I go there straight, sir? Okay, the estimate of current tax for the year ended June 30th, 2022 is 125,000 naira, while the deferred estimate for the year is 167,000 naira. The estimate of allowance for receivable was revised to 10% of trade receivables. Adama PLC issued 100,000 ordinary shares at 1.2 naira each, fully paid at the year end. Required: prepare for Adama PLC the following financial statement. 1. Statement of profit or loss and other comprehensive income for the year ended June 30th, 2022. 2. Statement of changes in equity for the same period. And 3. Statement of financial position as at June 30th, 2022.
Thank you very much. Thank you very much. So, again, I will need you to pay attention. And as I'm finishing one side, I will be cleaning it to move to the other side. It's even better for you to pay attention. Then, when I send you the solution, you can transfer it to your note yourself. You will have learned it. Yes. So, just pay attention and listen very well. Okay. Now, so this question is a bit more advanced than what we have in our notes or in your pack, because this one has few additional information. And these three areas of additional information I've added is an area that you will always find in your exam. So these three are common. The additional information you have here, they are common. Every diet, they are there. So it's proper for you to be familiar with them right from the beginning of the diet. So as you move on, when you keep seeing it, it's going to be very easy for you to treat them. So usually, question like this is our question 1, and it's always 30 marks, so it's big deal for us. And when they give you a trial balance like this, a trial balance majorly are list of balances. They are what? List of balances. When I say list of balances, I mean list of ledger balances. So it's always prepared majorly at period end. It could be prepared at month end. It could be prepared at end of every quarter. It could be prepared at the end of the year. And a trial balance would have a debit and a credit side. The items on the debit side would be items of assets and what? Expenses. Majorly, the items you find on the debit side are majorly what? Assets and expenses. The items you find on the credit side of the trial balance are majorly income, liabilities, and what? Equity. Those are what you find on the credit side. Now, majorly, you see, the items of the statement of financial position item, like assets, liabilities, and equity, they are always cumulative, meaning that they are the figures as at the date of the trial balance. Most of them, their balances were brought from the previous period. Not even most of them, all of them, except an asset or liabilities or equity that we originated in the current year, meaning that occurred in the current year. Other than that, they are mostly brought forward from the what? From the previous year. So the only ones that occur in the current year are majorly income and what? Expenses. Income and expenses. So you need to have that background knowledge now because it will help you. Now,
Now, my question is, if we are preparing a financial statement for probably at the end of the year, so that is 31st of the December. Now, which one is the previous period and which one is the current period?
Okay. So if we are preparing account for, let's say, 31st December 2023, so the previous period will be 31st December 2022 or 1st of January 2023. Okay. So if they ask you present an account as at or for the year ended 31st December 2023, that's the current year. That is the current year. So any period, yes, any period like the 12 months before that period, okay, like from 1st of January 2023 backwards are the previous years. Okay? Yes. Yes. Those are the previous period. Okay? Now, with that background knowledge of trial balance, so your exam will always give you additional information. And this additional information majorly are events that occurred in the current year or events that only occur at the end of the year. That they cannot happen during the year. They can only happen at the end of the year. So since they are new events, since they are new transactions, that means you have to adjust for them. That means you have to update the figures in your trial balance with them. And since they are new transactions, that means you have to pass how many entry? Double entry. Double entry. So it's at this stage, you might probably need a bit of double entry knowledge, what to debit or what to credit. Alternatively, we will give you another option for those that are not very good with double entry. We'll see how we can manage around that. So now, in this case, let's start with the additional information, which is where you have to always start from. And that will be our workings. Now, the workings one said that the estimate of current tax for the year ended 30th June 2022 is how much? 125,000. So this is telling us about the current tax for the year. And they also say, while the deferred tax estimate, I omitted tax there. It should be deferred tax estimate. While the deferred tax estimate for the year is how much? 167,000. So they gave us information about current tax and deferred tax. Okay. You have done IS-12, I guess. Right. So you know that the current tax is the tax that is payable on our taxable profits or on our profit for this year. So the amount of tax that is payable or recoverable from the taxing authority is the current tax. So ultimately, you're supposed to pay it like as immediately as possible. But the reality is this: the way taxes work is that it's not something you can determine during the year. It's something you can only determine at the end of the year. That is why current tax, you will only find it in the additional information because it can only be determined when you have gotten your profit. In fact, when you have prepared your management report. Companies that don't have tax departments will send it to their tax consultant to help them do their computation of tax. Those that have a tax department will come up with their computation of tax. You see, that computation of tax we are doing, we would eventually put it in our management report. We'll give it to our auditor, they will audit it, then prepare our audited report. Now, see, that tax is not the actual tax you are supposed to pay to the taxing authority. That tax, we can only describe it as accountant as an estimate of tax. The only body that has the final authority to tell you the amount of tax you will pay is FIRS. So eventually you will submit your books to them. Eventually they will carry out a desk review. Eventually both of you will agree how much tax you are supposed to what? Pay. We'll get there because there's always a fallout. But initially, you will do your tax estimate, abi, and you have to enter it in your books. And that estimate you do, that tax estimate we do for the current tax is what they are giving us here as 125,000. So our first responsibility here today is how do we enter this in our books? What will it affect? These tax estimates. Who can guess? Who can give it a trial? What will it affect? What are the items it will affect in our books? Tax estimates. What's the impact of tax? You need to what?
To check whether it is increasing or decreasing.
Okay, so have you checked it? So what will it affect? What items will it affect? Any trial? Just try. My friend, I've been expecting you to raise up your hand. Eventually you did. Okay, what items will it affect? Let's tell us.
It will affect the financial position, maybe asset or liability, different tax asset or different tax
No, no, no,
liability.
no. We are talking about the current tax now, not the deferred tax yet.
Oh, different tax.
What do you think? I think you should try. Okay. Okay, you want to try? Yes. Just tell me the double entry. Okay. And bank. Okay. Remember that you're not paying it yet. It's just an estimate of tax. We are not paying it yet. What do you say? No, it's not deferred tax yet. It's the current tax. Okay, please try.
Okay, we're going to check whether it's a credit or a charge. Since they gave us like deferred tax at the beginning, also at the end.
Don't, it's not deferred tax. Current tax. Leave deferred tax alone. We are not there yet.
Okay.
Why are you going to deferred tax? Please try.
It affects your current liabilities.
Thank you very much. You are not paying it. So you are owing it. So it will affect current liability first. So you could call it, you cannot just say current liability. You need to call it a name. You can call it current tax liability. But you know that it's going to be a current liability because you have to pay it immediately. But as of today, you are owing it. So the first item it will affect is your current liability. So you can call it current tax liability. What other item will it affect apart from your current liability?
It's going to your profit.
Thank you very much. Smart guy. It will also affect your profit. Yes, now. What will it do to your profit? It will reduce your profits. It will reduce your profits. Okay. So, see, nobody cares whether you tell us if debit this, credit that. In fact, don't even do that in the exam. We don't care. So that's the debit this, credit this. It won't really take us far, at least at this level. We have tested that at your foundation level. What we need to know is that which items will it what? Affect. And he has told me perfectly. The first thing is that it will increase our liability. It will do what? Increase our liability. So if it's increasing our liability, so what do we call it? We call it current tax liability, since we are dealing with current tax. Abi? The second leg, he told us that it will reduce our what? Profit. And what reduces our profit? Expense. It's expense that can reduce your profit. What increases our profit? Income. So if you can think that the impact of this thing is to reduce our what? Profit, then you know it's an expense. So there's going to be an increase in expense and an increase in what? Liability. That's it. So if you are not fortunate to remember, if you know the double entry, if you are not sure of the double entry, don't go and do debit this credit that too. Don't do debit this credit because that is worse. For you to now say debit this and you are now wrong, that one is worse. So if you are not 100% sure, just leave their debit credits. Do increase in liability, increase in expense. You will get full mark. Okay? But for knowledge sake, whenever your liability increases, whenever your what? Liability increases, you credit. Whenever your liability what? increases, what do? You credit. Is a rule of double entry. And the reverse is the case. If your liability should decrease, what do? You debit. Again, when your expense increases, you debit. You what? You debit. And the reverse is when it decreases, what do? You credit. If you can know that one, at least for today, you're getting there. So whenever you see a transaction that increases your liability, you know that you credit that leg. Ordinarily, when we say it increases our current liability, that means we'll credit current tax liability. When we say it increases our expense, that means we'll debit our expense. Just that you don't just call it expense, you need to give it a name. We call it current tax expense. So the expense side, we call it current tax expense. The liability side, we call it what? Current tax liability. And that is it. So if this is how they have just given us in the exam, all we just do is that in our current liability, when we are preparing our statement of financial position, we will go and put there current tax liability. How much? 125,000. When we are preparing our statement of profit or loss, after our PBT, there is always income tax. We'll just go and put current tax expense. We remove it from our profit. 125,000. And we are done. And we are done. Okay? That's usually how they will test it in the exam. But this guy went more advanced. He went more advanced. And what happened is that if you check your trial balance, there's a current tax there. There's a current tax in our trial balance. So, what does that represent? How much was it? 20,000. So, what would that represent? Where can that fit in this explanation now? Where can I fit in? Yeah, you need to understand why we are adding it. Why are we even adding it? Say it now. Okay, she's actually correct. She said it's the previous year estimate, right? So, though not perfectly correct, right? So, whenever you see current tax in the trial balance, it's a fallout from the previous year. It's just a balance from our estimate from the previous year. So, there's a lot of story behind it, but the thing is this. For example, now, let's say like we made an estimate this year of 125,000. When the tax authority checks our books eventually, three things can happen. Is it that the tax authority say, yes, this is the perfect amount you are supposed to pay, go and pay it. Or they tell you that, no, this your estimate is small, oh. What you are supposed to pay is 130,000. So in that situation now, what has happened to you? You had underestimated. So in your books, there will be a balance. Okay, that's that balance you are seeing in the trial balance. So whenever the balance is on the debit side, it means that you underestimated. Whenever the current tax is where? On the debit side, it means you underestimated in the previous year. Meaning that you underpaid by how much? By that amount. Yes. If it's on the debit side. So the impact of that is that you have to now consider it as part of your expense this year. It will be an additional expense for you this year. If it is on the credit side, okay, so that's a situation whereby you estimated 125,000 and the taxes authority says, no, your money is 120, right? Your money is 120. That means you had what? Overestimated. That is when you find current tax on the credit side. That will reduce your expense for this year. That will do what? Reduce your expense for this year. Okay, so for current tax, this is how far the examiner can go. In fact, in most of your exams, like last diet, you will not find the current tax in the trial balance. All they will just do to you is give you the current tax in the additional information. and just pass those two legs. One leg as part of current liability, and the other leg take it as your expense, and that's all. But this one, I went more advanced. When you have it in the trial balance, it means there was either an underestimation for tax if it's on the debit side, or an overestimation for tax if it is on the credit side. So how do we treat that? So ordinarily we call it income tax. And this income tax is the aggregation of your current tax and your what? Deferred tax. If not for the fact that there is a figure in the trial balance, we will have just put this 125,000 here as part of our income tax. But we need to adjust for that. So 1A, current tax. So as per my trial balance, was it on the debit side or credit side? So it was an underestimation for what? Underestimation for current tax, which is how much? Which is 20,000. And what was our current tax estimate for this year? Our current tax estimate for this year was 125,000. So since this was an underestimation from last year, the impact is that it's going to increase our expense for this year. It's going to what? Increase our expense of this year. So our total tax expense is going to be how much? So this one will show where in our statement of profit or loss as an expense. So I can easily transfer that here as how much? 145,000. If I may ask you, what's our liability for this year? What's our tax liability for the current year? 125,000. This is our estimate for the year. So this is what will still go to our what? Statement of financial position. So the common mistake students will make is that, yes, these are tax expense for the year. You now go and make the mistake of go and treating this also as our liability. This is not a liability for this year. Okay? The only liability we have for this year is the estimate for that year. Is the what? Estimate, which is 125,000. So this is what we show as current tax liability in the current liability. So this is current tax. It's not going to be more than this in the exam. If you understand this, you're good. Yeah.
Now, how is it different from deferred tax liability? It is the same thing as deferred tax liability. Since we are not paying that, we are carrying it over.
Okay, good. So the first thing is that this one is just an issue of you are supposed to pay 120,000, but you estimated 100,000. Okay, so ultimately you eventually pay up, right? You eventually pay up. So I think we should go to deferred tax immediately so that you see the difference clearly. Okay, so for deferred tax, there's a long story behind it. I don't know how you were taught, so I don't want to deviate from it. But for simplicity, ultimately is a tax that might be payable or recoverable in the future. Okay, even though that definition is wrong, because deferred tax is never payable or is not something you pay or recover. Really, the technical part is that it's an accounting measure that is used to match tax with accounting impact of transactions, right? But I don't want to go there, really, but see it as the amount of tax that is payable in the what? In the future. That's deferred tax. And the way deferred tax works is that we usually make estimates of deferred tax at the end of each year. Okay, so at the end of each year, we will do our deferred tax estimate. Second year, we'll do our deferred tax estimate. So every year, we are doing our deferred tax estimate. If you look at this question now, what was our deferred tax estimate? So our deferred tax estimate for this current year is 167,000 naira. So the same treatment with the current tax. It affects two items. The first item is going to be our what? Liability. Okay? So for deferred tax, is not a current liability because we don't even know when we will pay it. Okay, that's the area of difference to this one. This one, you know that you have to pay it almost immediately. But for deferred tax, we don't know when we will pay it. I'm just trying to be simple with deferred tax because deferred tax is not a tax you pay. It's just an accounting measure to show the tax impact of every transaction. That is what deferred tax is. It's just an accrual for tax. You're just accruing for tax in transaction, but don't let us go there. But the way I want you to understand is tax that is payable or recoverable in the future, just that we don't know when it to pay, when we are going to pay, is a long time thing. It will take years before it's eventually resolved. So instead of current liability, it goes to where? Non-current liability. And of course, because it's still tax, it will reduce our what? Our profit. Okay? And what reduces our profit? Expense. Okay? So again, there's an increase in liability and there is also an increase in what? Expenses. Okay? But again, if you look at this one, we had a deferred tax in the trial balance. Right? We have another deferred tax in the trial balance. So what would that represent? What's that one in the trial balance? The one in trial balance, what is it? Thank you very much. That's the estimate of last year. That's what? Estimate of last year. Okay, so how do we impact that in our books? So the way you resolve that for deferred tax, first, as per our trial balance, which is the estimate of the previous year, which is how much? And what's the estimate of the current year? $167,000. Okay, so since we are having estimate every year, so we made an estimate of 100,000 last year, and this year now we have revised our estimates to be how much? 167,000. So that means we have to increase. There's an increase in estimate by how much? 66 what? 66,922. So this is an increase in what? In deferred tax. Okay, please note for deferred tax is either the increase or decrease that goes to POL. Is either the what? The increase or decrease that goes to POL. So where does this one go? So I simply transfer it where? Since it's an increase in tax, that means there's an increase in what? Expense. So this one is an expense. That is why we are adding the two together. If we were to be a decrease, meaning if instead of 167,000, what we add is, let's say, 89,000. That is a what? A decrease. Decrease is an income. So instead of adding it to this one, we will have what? Removed it. Again, what will go to our non-current liability? 167,000, which is our estimate for the year. That is our liability for this year. Goes to statement of financial position. Okay, now that we have gotten what will go to P&L and what will go to financial position, please let's aggregate these two together. What do we have? 211922. Okay, so if you understand this now, it's fine. If you don't understand this, you can listen to this over and over again until you get it. And not only that, I will have given you a lot of assignments. Okay, so you understand it better by the time you do it over and over again. So when you get to the exam, it's not going to be an issue for you. Now let's go to the additional information 2. Let's go to the additional information 2. And this additional information 2 talks about the estimate of allowance for receivables was revised to 10% of our trade receivables. It was revised. Okay, yes, the one we did today, there was allowance for receivables there. But that allowance for receivables was only in the trial balance. You see, what allowance for receivable means is something we used to call provision for doubtful debt before. But now it's called allowance for receivables. When you go to advanced classes, you will know it's actually an impairment of financial assets or impairment of trade receivables. But for now, it's okay for you to still describe it as allowance for receivables. So what happens is that when we sell to customers and we sell on credits, we usually make an estimate or we do an expectation that they might not pay. Not that they have not paid, but because of the condition of the guy, we are just saying maybe he might not pay. Okay? And that is supported by prudence under faithful representation, that care should be taken in the recognition of assets and income. So that's what the guy is saying. He doesn't want to be over optimistic that, okay, certain percentage might not pay. So the way it works is that at the end of every year, we re-estimate it. Just like we re-estimate our deferred tax. It's the same way we re-estimate our allowance for what? Receivables. Because somebody whose condition was like this last year, his condition might be like better the second year. So you need to re-estimate whatever you think he might not pay. So we do the estimate every year. So that's what has happened here. So in this current year, they estimated that 10% of the trade receivable might not pay. That is allowance for receivables. But that, not only that, we had an allowance for receivables in our trial balance, which is the final item in the trial balance, and it was 60,000. That was the estimate for last year. That was the what? Estimate for last year. So how do we deal with that? Similar to the way we dealt with deferred tax. So as per our trial balance, that's the estimate of the what? The previous year. And it was how much? It was 60,000. And what's now in the additional information? Allowance for receivables in brackets is the estimate of what? Of the current year. And it was how much? It's 10% of how much? And what's our trade receivables? 579,065. And that is 57,906.5. Let's just approximate it since we are using level of rounding off, right? So there's a decrease in deferred tax. There's a decrease in what? In allowance for receivables. So how much is it? 2,094. Decrease in allowance for receivables. Now, usually, allowance for receivables, the way it's treated, if you remember, we remove it from our trade receivables. It's always a decrease in assets. And decrease in assets, if you remember the definition of expense, expense is a decrease in what? In assets. So this allowance for receivables on its own is an expense. 093. Okay, thank you. Okay, because you made a mistake. Now, this decrease in allowance for receivable now, will it be an expense or an income? An income. Can you please clap for her? That's my girl. Okay, you're welcome. It's an income. Decrease in allowance because these are a decrease in expense. Abi? Okay. Now, let's go to the third additional information. And this talks about Adama PLC issued 100,000 ordinary shares at how much? 1 naira 20 kobo each, fully paid at the year end. Abi? Okay, please. I can't hear you.
Allowance is it based on trading, is it fundamental, or is there an analysis derived for each customer in practical way? How do you get?
Okay, so he's saying that is there a mathematical or scientific way for us to determine our allowance for receivables? Well, it depends. It depends. Usually, most entities will have an age receivables. Okay, and when they have an age receivables, they can use that to determine the proportion that might not pay. Right? They might, so there is no generally scientific way that this is the way we determine our allowance for receivables. So there is no that. But some entity might have an age receivable. So on the basis of that, they can say that okay, this guy has been owing for the past 1 month. He has not paid. So on this basis, let's assume he might not pay. So it's just an estimate. So let's say 10% of it would actually default, right? But you see, I just don't want to go into this. IFRS 9 says that as soon as you originate a financial asset, okay, you should they actually call it a 12-month credit loss. Yes, a 12-month credit loss. So assume immediately that he will not pay. So it's really not scientific, it's just an estimate, right? And again, he now mentioned that if you have a way internally to determine this, please go ahead. So really, there's no scientific way for us to determine it, but we expect that as soon as you originate that financial asset or that trade receivables, or when you sell on credit, just you can assume that maybe 1% might not pay. But if you are confident that this guy will pay, you can say this guy will pay. So that means you will not make any allowance for receivables. So it's not compulsory you make. If you are sure that the guy will pay, it's okay. But by the time somebody start owing you he's supposed to pay on the 8th of July. And this is 8th of August. He has not paid. You see? Nobody needs to tell you as an accountant for you to let's make an allowance for receivables. And how do you determine that estimate? Is management judgment. Okay? Now, let's go to issue of shares. Okay. Now, if you remember our statement of changes in equity, right? You know that we usually have ordinary shares, share premium, and all of that. Now, what usually increase your ordinary shares and share premium is where there is an issue of shares. right? So in this case, we issued shares at 1 naira 20 kobo. We issued new shares at how much? So can you think of the items this one will affect in our books? Just when you issue share capital, you know what it means? It means that you want to raise more money from people. Okay, Mr. Omar. It will increase our equity, and that's correct. It will increase our equity, but that's one leg. There's another leg. Asset, which asset now? Which asset? Which one? Tell me the name. You have to give it a name. Cash. That's correct. That's my boy. Cash. So those are the two assets it will increase. Yes, it is going to increase your equity because you are going to have more share capital, and it's also going to increase your money because you are going to receive money. Abi, that's the specific asset. Okay, that's correct. Smart guys. Okay, so issue of shares. So let's start with the money we will receive. We will receive money. Abi, how much are we receiving? We sold the shares at how much? 1.2. Ordinarily, we call this 1.2 issue price. We call it what? So how much are we receiving in total? 120,000. That's the issue price. So as you have said, bank is an asset. It has increased. It has what? Increased. When your asset increases, do you debit or credit? Debit. You're already knowing double entry. When your asset increases, you debit. So simply, we will debit this what? This bank. We debit it. Now, that increases. Mr. Amok said that our equity will also what? Increase. So the first equity is your share capital. And it's going to increase by how much? 100,000. Multiply by what? Multiply by what? Multiply by what? Say it loud. 1 naira, 2 kobo. 1 naira, 2 kobo. No, it's 0.5. It's 0.5. Your share capital that you find in the books of any company is always the amount of share capital that is registered with CAC. It's always the amount of share capital that is registered with what? CAC. Okay, so if you want to confirm their share capital, just request for their CAC documents. If there is variation, as an auditor, you pass journal and return it back to what? Except if they can explain that there was an issue of additional shares, then I advise them to go and register it with CAC. Otherwise, whatever we have as share capital in the statement of financial position must equal what is in their forms, their CAC forms. And CAC forms, the value of share capital is always valued at nominal value. It's always valued at what? Nominal value. Okay, that's why share capital is always at nominal value. But the question you should ask is, where did I get this nominal value? Did I call CAC? They from the trial balance. They always give you. Okay, and they gave us as 0.5. Another way they can give you in the trial balance is that instead of putting 0.5 there, they can tell you that ordinary shares capital, they can put in bracket, they will tell you the number of shares. They will tell you the what? The number of shares. So all you just need to do is whatever the value is, so what will you do to it? You divide it by the number of shares. That will give you the nominal value. Then that's what you use to increase your share capital. And this is how much? So when your equity increases, because the impact of this is that our share capital will increase by how much? 50,000. Do you debit or credit? Credit. Credit. Now, there's a balance of, because this is what we received 1.2 and we have credited 0.5 to share capital. So there's a balance of how much? 0.7. Where will that one go? Share premium. Share premium. So this 100,000 multiplied by what? 0.7. And this is how much? And this is 70,000. Okay, so usually when the issue price is higher than the nominal value, which is always the case, you never find a situation when the issue price will be lower than, hardly, it's not possible except the company is gone, right? So the excess, we call it premium. So this 0.7 is premium, the premium you have collected. So go and keep it in a reserve. So this share premium is a reserve. So we call it share premium account. So that's why you will find it, it's not there. So it's always in a statement of changes in equity. It's part of equity. So when you say equity, equity is share capital and reserves. Share premium is part of it. Okay, so we have solved everything. So now let's start preparing our statements. Let's start with the statement of financial position. No, statement of profit or loss. Remind me when I'm preparing statement of financial position, ensure that I have prepared statement of changes in equity. Okay? So that I will not make that same mistake. Okay. So what's the name of this company? Adama PLC. Statement of what? Of profit or loss and what? For the year ended when? June 30th, 2022. Abi? I noticed that when you want to ask a question and I give you the mic, you always, um, your tone will change. You just have to assume that the mic is not there. I mean, some of you might want to still watch this video. Why some people don't like watching videos, but for people that have missed the class or somebody that wants to do revision, it's always good. Let them hear the question you're asking. They actually benefit. Like the question this guy asked me the other time was very good, and you have been asking very good questions. So I have to give you the mic so that they can actually follow the class very well. Okay, so let's start with the revenue. Revenue. And how much is our revenue? Sorry? Yeah, that is it. 2 million. Do we have any returns in words here? We don't have any returns in word in this question. If we had, we would have removed it from our revenue. We'll have what? Removed it from our revenue. The next one is what? Our cost of sales. And how much is our cost of sales here? 995,000,003. If we deduct this from that, cost of sales from revenue, what do we have? We have our gross profit. And how much is our gross profit? 1,147,816. That is our gross profit. Then after our gross profits, we'll check if you have other what? Other income. Do we have any other income? Do we have other income here? Okay, so gain on translation on foreign operation majorly means exchange difference on translating a foreign subsidiary. I don't even know why this is here in your question because it's beyond the scope of your syllabus. When you get to corporate reporting, we'll teach you foreign subsidiary. When a parent acquires a foreign subsidiary, they need to consolidate it. So before they can consolidate, they will need to translate the financial statement of that foreign subsidiary into their reporting currency. It's just like, let's say the foreign subsidiary is in the US, they will report in dollars. Before they can consolidate it with their books, let's say the parent is in Nigeria, they will need to translate those figures in dollars to naira. When it translates, there is always gain or loss on translation. We call it exchange difference. That exchange difference goes to other comprehensive income. Okay? So it doesn't come here in P&L, but OCI. Right? So let's leave that for now. Any other one? Investment income. So investment income is not other income because there is a specific line for it called finance income. Okay, so it will not come here. Any other one? Exactly. Decrease in allowance for receivables. Decrease in allowance for receivables. So, and that is our income. Okay, so other income, note what? Note 2, and that's how much? 2093. So, apart from that, that's the only other income we have. Let's have our administrative expenses. And how much is our administrative expenses? 173. One seven three seven two seven. Then our distribution costs. 161 128. That's our distribution costs. Then let's cumulate this. 815054. Then it will be a finance cost. So our finance income, this one will be our investment income. In the solution I'm going to send to you, I've already broken, I put it as a note there for you. Finance income, I've put investment income. So you will see it there. So what's the finance income? 65 2 for what? Then we'll have what again? Finance costs. Okay, so this finance cost, I have to work this out. Is majorly the interest on borrowings. Abi? Do we have any long-term loans here that we have to pay interest on? Okay, 3% redeemable loan. By the time you see something like that, it means that we pay interest every year. Every other year we are paying interest. So let's check the trial balance. If we have any interest on loan, how much? Okay, so that's that interest we're supposed to pay. Okay, so whenever you see interest in the trial balance, it means the interest we have actually paid. It means the interest we have what? Actually paid. So first, let me start with as per trial balance, which means the interest what? Paid. And it was how much? 14,763. Okay, so let's compare it with the interest we should pay. Okay, what we should pay, meaning the interest payable. So what's the interest payable? Is 3% of what? The interest we're supposed to interest payable on the redeemable loan note, Abi? So this is what we should pay. So how much is it? Let's see if it is what we actually paid. What's 3% of 843,000? How come now? How can 3% of 843? It's not 30% though. 25,000. Okay, so this is what we should pay. This is what we paid. That means we are still owing how much? How much are we owing? Sorry? So this, we call it what? Accrued what? Where will you treat it? Is it current or non-current? Current liability. So this will come in the statement of financial position. But the question is this: what goes to P&L? Is it what we paid or what we are supposed to pay? What we are supposed to pay. Right. So this goes to statement of profit or loss. You have to be very careful here.
Anytime we see this something loan notes in the trial balance, and we also see interest, we must compare it like this every time.
Every time you have to.
Is it applicable to loan notes?
All non-current liabilities that has a fixed interest attached to them. You will see, we will solve a lot of it. A lot of it. At least before you go to exam, we'll have solved like almost 10 scenarios. So when you get to the exam, it won't be new. You will have seen different scenarios. That's if you are doing my assignment anyway. If you are not doing it, there's no way you will see any 10 scenario. The only scenario is like you see is like 2 or 3 that I will solve in class. There is class scenario you will see.
What of if they didn't put the percent inside the loan notes?
They have to. If they didn't put it, they have to. That's not normal, right? The normal thing is that the guy should get fixed interest, right? But if that's the case, brother, so that means they are not paying any interest. You don't even have to compare anything. Yeah, madam.
Okay, the loan note, like this example, we have the 10% loan note and also interest on 10% loan note.
You have to
So,
compare it. You have to do the comparison.
so this one has been paid.
Yes. So you compare it with what we are supposed to pay. You get the idea now. So that means there will be a difference that we are still owing. So the one you are still owing, put it as liability. The one you are supposed to pay, that is what goes to your P&L. Yeah, I mean, you need to attempt it for you to be sure that you understand it. Which one? The one we are supposed to pay? Yes. Exactly. So he said that what if the 3% equals to what we are supposed to pay? Then fine. That means nothing in liability. Just put that amount in your P&L, and that is even more straightforward. That is even more straightforward. But I mean, the guy will not want to give you that in the exam. They want to make sure you understand those things. Yes.
So supposing we are only given the interest paid alone without comparing, giving another figure, are we going to pick this one directly to?
Yes, you just pick that directly to P&L since they didn't give you any other thing. But they should, because whenever there is an interest, there should be a loan that generated that interest. There should be a reason why we are paying it. So they will give you.
That the difference between the expense, let me just like expense and liability. The expense is more the liability is an expense you have incurred but you have not paid.
Exactly.
Why your expense is what you have paid.
No, both the one you have paid and the one you have not paid.
So why is it different?
You see, it's just accrual concepts, accrual basis of accounting. So we account what we put as expense is what you have incurred, not necessarily what you have paid. Okay, your interest that is payable from here is 25,290. So out of that 25,290, you have paid 14,763. Okay, so what your expense is 25,290. Yes. Of course, since you have not paid everything, that means you are owing. Is a liability. Okay. So our finance cost is how much? 25,290. So what do we have? Profit before what? Our profit before tax. So how much is our profit before tax? You're just dubbing, you're not pressing calculator. How much? Then we'll have our income tax expense, which is in note 1. As how much? 211. Then what do we have? Our profit for the year is how much? Okay, do we have any item of other comprehensive income here? That's gain on foreign operations, right? Okay, that's not, this is in the trial balance. It means it's a brought forward from last year. Is a what? Is a brought forward from last year. The one that will go for this year, they will have given you that in the additional information. Okay, which we will not look at a scenario of gain on translation, but we'll look at a scenario of revaluation reserve next week when we start PPE. Okay, so we will see how we're going to look at that. So this gain on translation will not come in as a current year transaction because it's in the trial balance. That means it's a brought forward from the previous year. So that means we are going to stop here for our statement of profit or loss. Now let's go to our statement of changes in equity. Which one? There was a revaluation reserve. Okay, yeah. So that one too is a brought forward from last year. That also is a brought forward from last year. So most of these reserves that you see in the trial balance is a brought forward from last year. Don't go and treat them as a current year occurrence. It's a brought forward from last year. Okay? At least for reserves. For reserves. Yes, reserves. Yes. What is it? Yeah, exactly. The reserve that goes to OCI must be an occurrence for the current year. And that they will give you in the additional information. Okay? The one you find in the trial balance is a brought forward from last year. Okay, so let's prepare our statement of changes in equity. What?
Income tax and is it 30%? going to combine that this workplace and this tax
I
quantification.
don't get that question.
Like some person will say, oh, income tax, profit before tax, 30%, something like that.
Yeah, a good question should not tell you that. Yeah, a good question should not tell you that. But if that's the case, that means when you get your profit, okay, when you get your profit, you're expected to do 30% of that profit. But a good question should not tell you that. That's not a good question. It's not. Because really, by the time we do our computation, even though the current tax is 30% of your taxable profit, the effective tax rate is not always 30%. When you check it against your PBT, whatever the taxman has done or your tax consultant has done. So a good question will not tell you 30%. That's too raw and wrong because that 30% is not really applied on PBT, but rather is applied on taxable profit that we will have done after doing adjustment for disallowable expenses, adjust your capital allowances, and all of those ones like that. Okay, so let's do our statement of changes in equity. So, Adama, for the year ended June 30th, 2020, what? 2022. So, what are the items of equity we have here? We have our ordinary share capital. We have what again? What do you have again? We have retained earnings. What do you have again? We have revaluation. What do you have again? We have gain on translation. What do you have again? I mean, I don't know how I can expect this one to contain your answer book. This is actually last direct correction. Oh. Yeah. So just that I just adjusted it. There are some things they didn't put there that I put, and I removed some additional information that I've not taught you. That's all I've done. So balance brought forward. So the balance brought forward are just figures in the trial balance for these items. So what's the ordinary share capital in the trial balance? What's the share premium in the trial balance? 142. What's the retained earnings in the trial balance? What's the revaluation reserve in the trial balance? What's the gain on translation in trial balance? What's the general reserve in the trial balance? Okay, in fact, what we should do is, because of space, let's just remove this one. So when we are preparing our equity, whatever, we'll add it there. There was actually nothing that increased or decreased it. It's just that same figure. Okay? I know this one might not contain whatever. So let's just remove this one. So add everything for me. Add all this. How much? One million 180. Okay, and there was an issue of shares, and this is it. That's why I left it. So our share capital increased by how much? Our share premium increased by how much? There's a total of how much? 120,000. So I can clean it up. Okay. So the next one is the profit for the year. And how much was our profit for the year? What would that impact? Retained earnings. That's correct. 643,088. It comes to total. Okay. Is there any other item that will impact anyone? Yeah, dividend paid. And how much was it? What will it impact? It will reduce our retained earnings. 119 88 what? 880. 119 880. And that is all. Okay, if there is anything that will impact your evaluation reserve, you only get that in the additional information. So whatever reserve you find in the trial balance is a brought forward from last year. It's not an occurrence this year. So if there's anyone, they will give you the additional information that there was a revaluation this year. Please. Okay, we call it revaluation surplus, not profit on revaluation. Yes, to fast forward knowledge because we are not there yet. One leg will come and add one leg here. If there was an increase in the value of your asset, of course, first it goes to OCI. Of course, any item in OCI ends up here, so we put it here. The other leg is what you add to the cost of your assets. But we'll get there, we are not there. Right. Okay. So that is this. Now let's sum it up. So balance carried forward. This will be how much? 840,000. What again? How much is this? 212,000. How much is this? 774. I know this one. I know this one. How much is this? 1,954,388. Okay, so that's our statement of changes in equity. Now let's do our statement of financial position. So Adama, yes?
that this share premium
Yes.
that issue of share premium can be used
No, it can't.
in the case where the nominal value is higher than the price.
No, no. That again abnormal because that's not premium anymore. That's a discount, and it should not exist. It as if the company is gone. Like they just want to give the company out for free. That's why you will issue additional shares at a value lower than your nominal value. It should not be lower. Okay? It should not be lower than it. Okay. Then, as at year ended June 30th, 2022. So we have our assets and we have our non-current assets. So what are the items of non-current assets that we have here? If there is land and building, I think you should tell me that first. Is there land and building? So we have freehold land and what? Which is how much? 1 million. Which other one do we have? Office equipment. What was there no accumulated depreciation for this? How much is it? Accumulated depreciation on land and building? There is none. Okay, good. Office equipment. What was the cost of that? 865. Then we'll remove what? The accumulated depreciation, which is how much? So what do we have? Okay. Any other non-current asset? Delivery van. How much? 301. 400. Depreciation. 120. So how much? 180. 840. Any other non-current asset? Yes. There is financial assets and is how much? 844. 244. 200. Any other one? Intangibles. And it was how much? Okay, hold on. Sorry. 5,600. Help me add all that together. Oh, okay, okay. So she's asking that why is the financial assets non-current? Why is it not current? Yeah, I think yes. So financial assets is just like investments. It's just like investments. Okay? It's just like maybe you bought shares, or maybe you lent somebody money. So since they didn't give us any information as per the duration, so we assume it's non-current. Okay? So you could have invested for 5 years, you could have invested for 6 years, depending. And you can have invested and say, okay, maybe there's an agreement that you get your money back within the year or within 1 year. then that one will be current. But if they are just silent like this, it's assumed that it should be non-current. You get it? Okay, so when you added this together, what did you get? 2,207,240. So let's do our current assets. So what are the items of current assets we have here? Usually start with inventory. And how much is our inventory? 622,812. Then do we have trade receivables? How much is our trade receivables? 579065. Then you remove what? Which is how much? How much is our allowance for receivables? It will be that estimate for the year, which is 57,907. So when you remove it, what do we have? Five two one. Any other item? Any other item? Bank. And, and that was how much? Okay, so that means the one on the debit side is an asset. The one on the credit is a liability. Okay, so how much is the one on the debit? From the issue of shares. Ah, fantastic, fantastic. So in the solution I'll send to you, I'll break it down properly. So let's do 142,310. Abi, plus what? Plus 120,000. Abi, which is the money we received from the issue of shares. So add it together. 262. So what's my total assets? What's my total assets? You're all just dubbing. You're not typing. It's 3,613,52. You know that your participation in the class now gives you mark in your ICANN exam. You don't know there is CA now, continuous assessment. You don't know? Be dubbing, no. I said I will send you the solution. You know, I gbọ́dọ̀ dub. So let's do the equity and liabilities. First, we'll start with the what? Equity. And we're going to have ordinary share what? And from our statement of changes in equity, all the items in equity, in the statement of changes in equity, we'll come and dump them in statement of this equity side. And what we had there was 840,000 for ordinary share capital. And for share premium, We had 212,000 for retained earnings 774,780 for revaluation reserve. We had how much? 8,500. That was how much? Yeah, thank you. General reserve. How much was it? In the trial balance. Just get this one in the trial balance. I just intentionally omitted it here. You could have put it there if you want. 109, 809. Okay, let's just sum this together.
What of you are giving them money, just carry that total there and come and put that separate.
Ah, just you have to do it like this. You have to show it for exam purposes. They won't give you because this one has its own mark. This one is like 5 marks or thereabout. This one too has its own mark that they will give you. So total 2. Sorry. Okay. So let's go to our non-current liabilities. What are the non-current liabilities we have? I can remember that 3% redeemable what? And is how much? 800 and we have deferred what? And is how much? Thank you very much. Is that 167? So if you have preference share capital, you put it there. I've told you that the only preference share capital you should treat as equity if they specifically tell you that it is what? Irredeemable. Otherwise, just dump everything in as debt. So let's go to our current liabilities. First, let me put in my trade payables. And how much is my trade payables? How much? 353,846. What again? My current tax. We forget. And how much is that? Exactly. 109. That was in our workings one, Abi. This one too in our workings one. Yeah, accrued interest. And how much is our accrued interest? 10,527. What again? Bank. Okay, that bank overdraft. How much is it? 49. Any other one? I don't think we have any other one again. So by the time you sum this, all this together, ordinarily we expect you to give us 3,613,520. And that will represent our total equity and what? Total equity and liabilities. Okay. Okay. So in case in the exam, if you add it and it's not the same, just ignore and move on. Okay. Don't start looking for anything at all. Don't do that in the exam. Okay. So thank you.